Good afternoon, everybody, and welcome to today's webinar, Tax Planning for Buy-to-Let Landlords, which I'm delighted that we're running in association with MHA. For those of you who don't know me, my name's John Gaskell. I'm Head of Personal Financial Planning here at ICAEW, and I'll be facilitating today's session. So on the day of the autumn statement, we wonder whether by the time we get to the end of the webinar, there'll be any substantive changes and that James will need to rewrite his slides, but I think that's very, very unlikely, possibly a few tweaks. So bearing in mind that we do have a lot of material to cover, I won't dwell any further. I'm going to pass straight across to James. Over to you, James.
Well, good afternoon, everyone. Yeah, I've had a quick look at the announcements from the Chancellor in the last few hours, and thankfully he's said nothing that's going to render the rest of this hour session a load of rubbish. So I will simply crack on. I'm a tax partner at MHA, based in London, clients across the UK. I work mainly in private client, but our core client base is owner managed businesses, and therefore we've got a lot of landlord clients, do a lot of work in tax planning with landlords, particularly estate planning, inheritance tax planning, etc. So that's really going to be the focus of the webinar today, and I've set out on the slide here the areas I'm going to cover. I'm going to spend the first part of the session looking at some basic computational points with a few worked examples, which hopefully are very useful before looking at some more significant planning opportunities. I was reflecting over the last few weeks, and indeed with John a moment ago, that the recent rise in interest rates is likely, I expect, to result in more landlords considering using companies for their buy-to-let portfolios, as effective tax rates are pushed higher by the restriction to the deductibility of residential finance costs. So I'll look at the impact of rising interest rates and then the pros and cons of using a company for property investments. Then I'll consider some inheritance tax planning opportunities. IHT is, of course, a major concern for landlords because their rental businesses will not qualify for business property relief, which means the value of the business is exposed to inheritance tax. I'll consider the IHT planning alongside setting up a company for new investments, explaining again some of the features of family investment companies that I've discussed in my last webinar in the summer. So I'll try not to simply repeat myself there, because I'm conscious many of you may well have watched that webinar as well. And I'll also consider IHT planning opportunities alongside the incorporation of an existing property business. And then in the final section, I'll look at the tax implications of purchasing investment properties within a trading company. So not specifically looking at buy-to-let landlords, but looking at the situation where perhaps an owner-managed business has surplus profits retained within their trading companies, and they wish to invest that. So I'll look at the implications for capital gains tax and inheritance tax, and what can be done to restructure the business to separate the trading and investment activities if that becomes necessary. So moving on to the start of the talk and the basic principles. Don't want this to be sort of teaching you to suck eggs, so I'll skip through the first few slides, but just wanted to point out the basics to get going really. So all income from property situated in the UK is treated as arising from a single UK property business for income tax purposes. Likewise, income arising from non-UK land is treated as a separate single business for income tax purposes. If there is a partnership as well, or someone's a partner in a property investment partnership, as well as owning properties personally, then the partnership is treated as a separate business. And also, properties made available at below market rent are not pooled with other income and expenses of the property business. The kind of impact of this really is on the ability to offset losses. Losses can only be offset against profits of the same rental business. Okay, and final point there is really useful in terms of determining taxable rental profits, in that the provisions within the legislation that relate to trading income also apply to property income. So essentially the usual adjustments apply. One sort of fundamental principle is that rental income is by default assessed under the cash basis. Now that's on a receipts and payments basis if the rental income is below £150,000. But even where that's the case, you may elect to apply the accruals basis, so the proper accounting basis, within 1 year of the normal filing date. Now, joint owners may elect independently, and there are situations where this election can be very worthwhile depending upon an individual's particular circumstances. And that's the subject of the first example that I'm going to run through on this and the next slide. So imagine a situation, imaginatively named Mr. Bloggs has employment income of £35,000. He also rents a property, receiving rental income of £1,250 per calendar month, or £15,000 per annum. I've ignored expenses in this example for simplicity. Now, in the tax year 2022-23, there's a change of tenant on the 5th of October, so 6 months into the year. The previous tenant had paid £1,250 a month for the first 6 months. That's £7,500. And the new tenant opts to pay 12 months up front in return for a small discount. So he pays £14,250 up front and then pays £1,250 monthly going forward. Okay. Now, under the cash basis, of course, this means that the first £7,500 from the first tenant and the whole of the £14,250 from the second tenant comes into charge in the tax year 2022-23. So therefore, under the cash basis in 22-23, Mr. Bloggs' income is pushed into the higher rates of tax. His income is £56,750, the tax on which is £5,646. There's less tax to pay in the next year, of course, because only half a year's rent is taxable. But the total tax payable under the cash basis is £7,146. If instead he elects for the accruals basis, I won't run through the numbers, but you'll see from the bottom there that he saves £1,296 and also benefits in terms of his cash flow. So it is important to consider in many cases whether cash or accruals basis is most appropriate in any particular year. Residential finance costs, and again, we all know this. I'm sure the vast majority of you have dealt with cases where you've had to restrict the deductibility of finance costs. You will be aware, therefore, that tax relief for residential property finance costs is now given as a tax reducer at 20%. That's a basic rate tax deduction, rather than a deduction from rental profits. Now, this removes the ability to claim higher rate tax relief, but it goes further than that and can have other significant implications. So the slide here just sets out the rules in a little more detail. So sets out the piece of legislation under which the tax reducer is given, section 274. The qualifying finance costs themselves are restricted to those on the outstanding loans up to the original cost of the properties plus capital improvements. The tax reducer, that's the 20% tax reducer, will be calculated as the lower of 20% of the qualifying finance costs not deducted from rental profits, so the mortgage interest essentially, the profits of the rental business, or the individual's total income that exceeds the personal allowance. Any unrelieved amounts can be carried forward. And just as a final point, the same restriction applies to, or rather applies in respect of loans that are used to invest in a property investment partnership. So rather than debts of the partnership itself, if someone's taken borrowing to invest in a property investment partnership, the interest deduction they receive from that is similarly restricted. Looking at an example, though, a simple Google search tells me that the average rental yield in the UK is 4.71%. Clearly, there are going to be some wide variations, but I've used that 4.71% in my example here. So that would equate, roughly speaking, to a rental income of about £1,000 per calendar month on a rental property valued at £250,000. Okay. Now, the best 2-year fixed rate repayment mortgage at 80% loan to value that I could find on Tuesday, I think it was on Monday or Tuesday, was 6.49%. Now, based on 80% loan to value. Year one interest on that loan would be about £12,980. In June 2021, that was 3.19% or 6,380. Even for much lower loan to value, so 50% loan to value, the best 2-year fixed rate repayment mortgage I could find on Tuesday over 2 years was 4.39%. That gives you an interest charge of roughly 5,488 in the first year, compared to just 1.19% in June 2021. So the table on this slide here just is trying to show the impact that the increasing interest rates has on the effective rate of tax on a landlord's rental profits. So if we look first at the columns, or 2 columns entitled mortgage loan to value 80%. At the top here, I've calculated what the real economic profit or loss is. Ignoring expenses, I've just taken rental income less mortgage interest. Okay. Now, with the significant increase in mortgage interest, we are assuming we don't increase the rent to compensate. We are running at a small loss compared to a profit of 5,620 in the prior year. If we look at the income tax on that, because we can't deduct the mortgage interest in the computation, £12,000 of rental income is taxable. And if we assume the landlord is a 40% taxpayer, he's got other employment income or other sources of income, then the tax payable on that after the basic rate tax reducer is £2,400. So he's paying £2,400 despite not making a rental profit. Okay. Even in 2021, where there was a profit, the effective tax rate with a sort of 80% loan to value was 63% for him being a 40% taxpayer. Even at the lower end of the loan to value, so 50% loan to value, the effective tax rate last year for this individual would have been 43%. With the increase in interest rates, that's jumped to 57%. So you can see that you're likely to get questions from clients about, well, what can I do about this? You know, the tax rates have effectively increased very, very significantly. Okay. Other potential consequences. I think I've shared this slide with you before if you've seen this webinar before. But I list here some potential other consequences of the way that calculation works, which on the face of it are less significant, but they're probably things that clients will consider to be significant if they come to them as a surprise. So because we can't deduct residential finance costs in the pre-tax income, this has the effect of increasing a landlord's taxable income, which can in turn cause a loss or reduction of child benefit, because suddenly the high income child benefit charge threshold is crossed, for example. It could cause a loss or reduction of the personal allowance if it causes taxable income to exceed £100,000. It could cause a loss or reduction of the personal savings allowance, as perhaps it causes someone to move from basic rate to higher rate, or from higher rate to additional rate of income tax. And finally, it could cause an excess pensions savings charge, because adjusted income may well be pushed above £240,000, causing an annual allowance abatement down from £40,000. So all these things could come as a bit of a surprise for landlords, purely because of the way the legislation works to restrict relief. Okay, joint ownership. This is again relatively basic computational point, but it can provide some planning opportunities and also some things we must remember to get right from a computational perspective. Okay, so just running through the points here on the slide, joint letting does not of itself make the activity a partnership. And I'll come on to partnerships and property ownership or property investment a little later. Joint owners may agree a different division of profits to the underlying ownership. So let's say I own a rental property with my brother, for example, but he does all the work, we can agree to split the profits in his favour if we so wish. But the share for tax purposes must be what is actually agreed. You can't arbitrarily agree to put something different on your tax return, for example, just because it will save some income tax. Spouses and civil partners, though, must share profits equally for tax purposes where they jointly own property, unless both of the following. Firstly, the entitlement to the income and the property are in unequal shares. So let's say husband and wife own a property, 90% husband, 10% wife. And on top of that, both spouses must inform HMRC on Form 17 that their share of the profits and losses is to match the underlying ownership. Okay, so unless that election or form is submitted, spouses or civil partners must share property income that's owned jointly equally for tax purposes, irrespective of the underlying ownership. Of course, this does mean that spouses and civil partners can arrange ownership to improve their income tax position. So frequently we will be talking to landlords about ensuring that a greater proportion of the property interests are held by the spouse with the lower income to take advantage of using up their basic rate tax bands and such like. Further, for capital gains tax purposes, we will often advise property is put into joint ownership before it is sold, so as to take advantage of two annual exemptions, for example. And that's because the property can be put into joint ownership on a no gain, no loss basis and then sold. From stamp duty land tax perspective, though, you just need to be careful with that. If there is debt attached to the property, then the assumption of that debt or part of that debt by the recipient spouse is chargeable consideration for stamp duty land tax, and there's no spouse exemption for SDLT. Note, however, there's no 3% higher rate supplementary charge on transfers between spouses. That was inserted in said by Finance Act 2018 when it was decided that was a little unfair. Partnerships. So this is covered in HMRC's guidance manual, and I've given you the reference there on the slide. And as I said before, joint letting does not of itself make the activity a partnership, but for several reasons, property investors, particularly relatively significant property investors, may want to be in partnership, perhaps because they want more flexibility as to how they allocate profits and losses. And as you'll come to see from later on in the talk, it can make transferring the business into a company a little easier if you're in partnership than if you simply own property jointly. But what HMRC say in their manuals, and I've just copied a section here, is most cases of jointly owned property will fall short of the degree of business organisation needed to constitute a partnership. To accept that a partnership exists, you would have to be satisfied that there is a similar degree of business organisation as in an ordinary commercial business. Obviously very subjective. I believe in HMRC's manuals, might even be the same manual, they refer to a case of Griffith back in the, I'm going to say the 50s, I might be wrong. But I think in that example, there was joint ownership of 11 or 12 properties. So you get an idea of the size of business required for HMRC to be of the view that there's a similar degree of business organisation as an ordinary commercial business, for example. You could, of course, use a limited liability partnership to give you certainty that a partnership exists, because, of course, a limited liability partnership is a partnership in law. Just a reminder as well, I have said this at the start, that the profits and losses of a partnership are separate from personally owned rental property. So, if the partnership is loss making, you wouldn't be able to offset losses from personally owned property and vice versa, if that were ever relevant. So onto investing in a limited company. I will come on to some examples and how this can be planned efficiently. But just to start things off, I thought it's worth having a slide on the pros and the slides on the cons, or potential pros and cons of investing in buy-to-let property via a limited company. So firstly, on the pros, this list isn't exhaustive, and indeed nor is the next one. It's just the key points really that would typically come out would always come out when advising on this. Often within a company you pay lower tax within the company, which obviously a company pays corporation tax on its rental profits. At the moment that's 19%, but we know it's increasing to 25% from April 2023. That of course is versus rates of personal income tax, which are up to 45%, or actually if you take into account the finance cost restrictions, the effective rates, as I've shown, can be significantly higher than 45%, even if the individual is not a 45% taxpayer ordinarily. The company can deduct residential finance costs in full from the rental income. Profit can be retained in the company until it's required. This is a huge benefit to many, because it provides flexibility and the ability to arrange profit extraction tax efficiently. But of course, it also leaves more in the way of post-tax profit to either reinvest or pay down debt. So over a number of years, it can become much more efficient. And as you'll come to see, there are perhaps more opportunities for inheritance tax planning and succession planning within a corporate structure. There are, however, downsides, they clearly have to be taken into some serious consideration before going down the corporate route or the company route. Firstly, and I'll have a couple of examples of this, a couple of slides on this particular point shortly. But transferring an existing rental portfolio to a company may crystallise tax liabilities such as SDLT, or the Welsh or Scottish equivalent, and capital gains tax. So that's the first thing. If you're an existing property investor, actually, will I be able to incorporate without any tax liabilities, or should I simply consider using a company for my future investments? And that's often the first question. Tax on extraction, of course, in addition to corporation tax within the company. So, if we're in a situation where within a company, the shareholders are going to want to extract all the rental profit on an annual basis as taxable income, it's unlikely to be efficient from a corporation tax and income tax perspective. The benefits really play out where we're looking to retain profits within the corporate structure, or benefit from the flexibility as to the timing of profit extraction, etc. There's the potential for double taxation. Of course, profits within the company are subject to corporation tax, and obviously income tax or capital gains tax, depending upon how they are later extracted. And typically there'd be higher professional and administration costs associated with the company, and more than likely higher borrowing costs as well. But what about incorporating an existing property business? I kind of alluded in the previous slide to a couple of problems, or at least considerations from a tax perspective. So it's capital gains tax and stamp duty land tax that really needs careful consideration. Excuse me, coughing. But in the right circumstances, both can be avoided. Okay, this slide deals with capital gains tax, and to avoid a charge to capital gains tax on incorporating an unincorporated property business, it will be necessary to fall within the conditions for incorporation relief under Section 162 of the Chargeable Gains Act. Now, I've copied here the relevant provision and highlighted the key points, but broadly, the whole business must be transferred as a going concern to the company in exchange for an issue of new shares. Now, the way the relief works is that all or part of the gains arising on the disposal of assets are rolled over against the base cost of the shares. Okay, if there's a mix of shares and cash consideration, only partial relief will be available. And there might often be cash consideration. We might often plan for there to be cash consideration to leave money on loan account, for example. So I'll come on to that in one of my examples in a moment. Further, it's important to review the level of debt within the portfolio, because if the debt exceeds the original cost of the property interests collectively, perhaps because the proprietor has borrowed against the equity and extracted cash from the business, full incorporation relief won't be available. So it's very easy to say you're in business, you can claim incorporation relief, but it does need to be looked at on a case-by-case basis. And an important point for incorporation relief is that it requires there to be a business, and the term business is not defined within the tax legislation. There's a vast body of case law. You've probably heard me talk about it before in regard to, rather in the context of various different taxes. But the most referred to case for incorporation relief is that of Elizabeth Ramsey in 2013. In summary, the tribunal held that for incorporation relief, the term business is to be interpreted broadly. So that's helpful, very helpful indeed. But reference was made to the taxpayer undertaking about 20 hours of work a week on the business. And this now appears, and has done for some time, in HMRC's guidance manual. So there's a guide as to when you can be fairly sure that HMRC will accept that incorporation relief applies. Now, the specific guidance manual is CG 65715, according to my notes here. The stamp duty land tax position is more complex and can often be troublesome, or kind of prohibitive to an incorporation. Basically, where property is transferred to a connected party, or rather a connected company, the normal rule is that stamp duty land tax is charged by reference to the market value of the chargeable interests, or the property interests. That's under section 53 of the Finance Act 2003. However, in the case of partnership transfers, the market value rule is overridden by the rules of partnership transactions in Schedule 15 of the same Finance Act. Broadly, they allow for a family partnership to be incorporated free of stamp duty land tax, but in all cases we must consider the potential application of anti-avoidance provisions, and I refer to them in the final bullet point there. If there's a genuine partnership that's existed for many years, then there should generally be no problem in terms of the anti-avoidance rules. But in all cases, and certainly in all other cases, then extreme care should be taken. And the reason for family partnerships benefiting from this favourable SDLT analysis is because the members must be connected. Now, for this purpose, we look to section 1122 of the Corporation Tax Act 2010, and the rule that connects business partners is switched off. So we're only left with the rule of being connected by family. It is possible that non-family members can be connected under subsection 4 of that provision, but care and advice should be sought in each and every case. It's very case specific, and I can by no means sit here and say that it's possible for all partnerships of unconnected people to incorporate free of stamp duty land tax. Inheritance tax planning. Now, in terms of inheritance tax planning, there are two principal strands to this that I would like to run through. Firstly, and only briefly, I'll discuss making outright gifts of property interests. Then I'll talk about inheritance tax planning alongside establishing, firstly, new property investment company, and then also alongside the incorporation of an existing business. And hopefully that covers cases that are relevant to everyone listening. It's generally easier to undertake planning with an incorporated portfolio, hence I'm focusing really on that. But firstly, in terms of outright gifts, of course, the best inheritance tax planning, as everyone always says, is just give everything away. That's nothing new, and it applies equally to property interests, but of course with a couple of caveats. Firstly, though, a gift of property will be a potentially exempt transfer for inheritance tax. That means it falls outside of the estate after 7 years. If property is put into joint ownership, the retained share may benefit from a valuation discount and the Valuation Office Agency suggests discounts of 10 to 15% are appropriate for a 50% share, with the higher percentage appropriate in cases where the co-owner is in occupation. So we would usually see 10% discounts in that situation. However, as listed on the slide here, with property and gifts of property, we've always got the potential for a capital gains tax charge based on market value principles, and sometimes, of course, that can be prohibitive. It can be possible to gift property into a discretionary trust, for example, and hold over the gain and still get the kind of inheritance tax benefits after 7 years. But generally, we're thinking about capital gains tax if gifting property. There's also possible stamp duty land tax charges if there is borrowing, because if someone takes on property and assumes debt, that's chargeable consideration. And the biggest thing actually is that, well, the individual looking to do the inheritance tax planning might need to retain the rental income that arises from the property interests. Now, there are options in that situation. So this slide here covers a situation where someone's looking to gift property and keep the rent, or rather gift an interest in property and keep the rent. So you'll be aware that the gift with reservation of benefit rules, which in simple terms apply to make gifts ineffective for inheritance tax if the donor continues to enjoy the assets. So you would think that if someone gives away a rental property or an interest in a rental property, the gift with reservation rules would apply to keep that value within their estate for inheritance tax if they continue to enjoy the rent. Well, actually, Section 102B of Finance Act 86 provides that a gift of an undivided share of an interested land is not a gift with reservation in the two circumstances stated on the slide here. The first one is that the donor does not occupy the land or occupies it to the exclusion of the donee for full consideration, etc. Now, this first exception may be relevant where there's a share of investment property given away, as the rules do not, at least explicitly, do not prevent the donor from continuing to receive the rent, or indeed a greater proportion of the rent. In that situation, it's also considered that the pre-owned asset tax shouldn't apply, and that's on the basis that the donor does not occupy the investment property. The other exception noted on the slide here is not directly relevant for landlords, but it is interesting nevertheless, as it allows individuals to do planning with the main residence in situations where children are in co-occupation with them and are likely to remain so. In those situations, if property is put into joint names and they are all in occupation, with care, the gifted portion falls outside of the donor's estate, while the typically adult child is in co-occupation. But that's a high-level summary. I think if that might be relevant to you or any of your clients, take further advice. So what about making new investments within a limited company? So I'll cover a few examples in this following section over the next 5 minutes or so. Okay. Corporate ownership is often best advice if there's a desire for inheritance tax or succession planning at the same time. And so-called family investment companies can be structured to achieve this in accordance with the family's circumstances and the family's wishes. Now, companies can be created with different classes of shares, most often used to provide flexibility with dividend rights and to ensure the founders retain control, if that's, of course, important to them. They are most often funded with share capital or loan capital, or I suppose most often a mixture of both. Now, this was the subject of my last webinar, so I don't simply want to repeat everything, but I'll run through an example that highlights the key opportunities here. So if I just run through this, so mum and dad, both age 65, sold a business and have 5 million to invest. They want to invest in property for letting. They have 2 adult children, one of whom is married with two children themselves, and they expect to have more grandchildren. They want to provide for their children and grandchildren, but they want to retain control. They do not expect to ever need access to more than 2 million of the 5 million capital. So set out here is what we might recommend as a possible structure for the ownership and funding of the family investment company. We have £3 million of share capital divided into ordinary A, ordinary B and ordinary C shares, with the vast majority in the ordinary A and B share capital owned by the children. Okay, that's 1.15 million each. We might suggest 650k of ordinary C share capital is put onto a family trust, and that 650,000 is important because it would not exceed or shouldn't exceed the available nil rate bands of mum and dad, and therefore there should be no lifetime inheritance tax charge on that chargeable lifetime transfer into the trust. Mum and dad retain a small amount of ordinary share capital, but crucially the rights attaching to those shares probably or possibly give them control of the company. Now, with the remaining 2 million of capital, they loan that into the company as a director's loan, which of course gives them that flexibility to draw down against that loan free of income tax if they so wish or of course need to. And what are the benefits of this? Well, 2.95 million of the 3 million share capital outside of mum and dad's estates for inheritance tax after 7 years. All growth in value is out of their estate immediately. The rental income, if indeed it's property they go and invest in, is subject to corporation tax at 19%. Of course, we know that's increasing to 25% from April 2023. In terms of income tax, they've got flexibility to draw against that loan. We could route income or dividends via the discretionary trust, potentially allowing for income of up to 14,500 or so per grandchild, let's say, tax-free, by appointing a revocable interest in possession to them, so that they actually receive dividend income to use up their personal allowance and dividend allowance. And that would typically, the interest in possession would be appointed on a revocable basis so that they could be changed if, for example, different levels of income were required for different beneficiaries, or perhaps in this example, if more grandchildren came along and the trustees wanted or needed to benefit more people. And of course, the company gives them the opportunity for other remuneration planning. And the point I make on the slide there is that it opens up the possibility of pension contributions which in an unincorporated situation wouldn't be possible unless the individuals had earned income as well as their property income. Incorporating an existing business, this of course is perhaps more difficult, and certainly it's more difficult to undertake planning for existing businesses, mainly because of the inherent gains in the portfolio, as I've explained. But I'll set out an example on how we might recommend the client should proceed. Okay, so in this case, mum and dad are in partnership, so there's a property investment partnership, which you'll recall, of course, is helpful when looking to incorporate. There are additional rate taxpayers already with other income. The rental properties or partnership properties of 3 million, debt of 1 million, and base cost of 2 million, which means there's an inherent gain of £1 million in the portfolio. Okay, they've existing capital losses of 250,000, that's 125k each, and the rental income is such that they'll be paying an effective income tax rate of well above 45% due to the finance cost restrictions. They've got adult children and grandchildren, similar to the previous example, and they would like to incorporate both to mitigate income tax and do some IHT planning. Okay, we might what might we recommend? Well, the business is valued at 2 million with an inherent gain of 1 million. So we want to incorporate probably, but we we can take advantage of the capital losses available by issuing a mixture of shares and cash consideration. The chargeable consideration will be the proportion of the cash consideration. So in this case, we allocate 500k cash and 1.5 million shares, which will crystallize a capital gain of 250,000 to use the capital losses. There's then a £500,000 director's loan account, which provides the founder shareholders that flexibility to draw from the company, as explained in the previous example. The debt is transferred, probably refinanced at the time of the incorporation, and by extra statutory concession, the assumption of debt by the company is not treated as consideration for capital gains tax. The remaining 750k of inherent gain is just rolled into the shares. So the base cost of the new shares is not 1.5 million, it's £750,000. If we look at the initial balance sheet after this has happened, it's as shown here, and the net asset value has been split essentially between the net asset value within of the shares, that's 1.5 million, and the £500,000 capital loan, director's loan. In respect to the share capital, the inheritance tax planning options are more limited because any gift of shares will generally crystallise a capital gains tax liability. One option will be to create a growth share plan, which I'll discuss in the following slides. Firstly, though, just the final point I wanted to mention here is that when a business is incorporated under Section 162, the company is deemed to acquire the properties at their market value. So if properties are then sold by the company shortly thereafter, there may be little or no capital gain arising. Now, this is kind of an added benefit, perhaps in situations where a landlord is looking to reposition his portfolio. You know, I've had cases where we've looked to get out of certain properties, and it's been really advantageous to incorporate and for the company to sell, so that we don't have an immediate tax charge on the disposal. The full proceeds then being available to reinvest. Growth shares. I'm conscious I've got probably 5 to 10 minutes. Just about time, I think. I've certainly not got time, though, to go through growth share planning in detail, but the principle is that the company, or the newly incorporated company, will issue a new class of shares designed to capture the future growth in value. Now, it's a difficult concept to explain, but there does need to be a valuation exercise, and normally the growth shares will incorporate a hurdle value in order to keep the initial value of those growth shares low. So let's say if the net asset value of the business is 2 million, the hurdle value above which the growth shares participating capital value may be set a little above this, so that they can then be passed to family members or trusts without significant tax liabilities. Obviously, if the value is low, they can be moved or transferred with little in the way of tax liabilities. The effect is that the growth in value above the hurdle accrues away from the existing shareholders' estates for IHT. So it's long-term inheritance tax planning, ensuring essentially that an individual's inheritance tax exposure doesn't worsen. Also relevant is the different valuation principles for capital gains tax and inheritance tax. Shares are valued on a standalone basis for capital gains tax, but on a loss to donor principle for inheritance tax. So if there's significant value attaching to shares for CGT, or if individuals want to transfer some of the ordinary shares, they could consider transferring those shares to a discretionary trust, because that would allow a holdover claim. The downside of that is that the gain is preserved into the future, it's simply held over, and it's a chargeable lifetime transfer for inheritance tax. So transfers really are limited to the available nil rate band without incurring an immediate IHT liability. A couple of 3 or 4 slides remaining. A couple of points here on kind of tax traps that may well be associated with corporate structures, just to watch out for when establishing a family investment company, whether that be property or for other investments, or indeed trading businesses, to be honest. Firstly, the settlements legislation, and again, I won't go through this in detail, but it applies to redirect income to a settlor for tax purposes, and that will apply, for example, minor children are introduced as shareholders and income is diverted to them. So essentially, you can't pay dividends to your minor children, and to get a tax benefit, the income will be reassessed on the settlor for that purpose. This is a fairly well-known principle, so as I say, I won't go into any detail other than to say that the definition of a settlement is wide. So I've heard many people say, "Oh, can't we just give shares to the grandparents first, and the grandparents settle them onto trusts for minor children? That must avoid it." Well, I don't think it does really. certainly the legislation is drawn wide enough to catch that situation. Notably, the settlements legislation will not apply where there's a gift of real shares, in other words, shares that are not just a right to income, to a settlor's spouse or civil partner. So there is scope within the share structure to provide an income for spouses and indeed adult children where typically the settlements legislation shouldn't apply. Second to last slide, I'm going to 3 or 4 minutes, so I'll cut the final section a little short. Gifts with reservation of benefit. Now, I touched on this earlier, but consider a situation where you set up a company or a property investment company, let's say, and parents hold an equity stake in the company alongside others, typically their children, and they retain wide rights to determine income distributions. So in theory, parents could hold a minority share, but with 51% of the votes, let's say, and as directors of the company, they could in theory declare a dividend disproportionately to themselves or on their shares. It's not clear whether the gift with reservation rules should apply in that situation, possibly not. But to guard against it as a concern or a kind of route of possible challenge, you could consider restricting dividends through the Articles of Association, or perhaps consider each class of share having a fixed entitlement to profits. What we often see, particularly where we're looking at inheritance tax planning, is say we might value the shares retained by the parents. So the ordinary shares, which are then encumbered by growth shares, for example. We might value those ordinary shares and say look, the dividends or distributions, whether income or capital, cannot exceed for the ordinary shares their value at that date. And then in that situation, I can't see that the gift with reservation rules could apply. And as a final section, there is a number of slides here in this pack, which I shan't run through because I want to leave some time for questions. But I'll go through just the first couple to give a flavour of what I want to talk about. So I just wanted to deviate slightly from buy-to-let landlords and look at the situation where clients wish to make investments, including property investments, but not limited to, within their trading companies. Of course, it's quite common where there are surplus or retained profits, and they would rather make investments in the company to avoid paying tax on extraction. But this brings with it inheritance tax and CGT implications potentially. But at the same time, it can be very efficient, at least from a tax perspective, to hold modest investments within a substantially trading company. Now, the issue for capital gains tax is losing access to business asset disposal relief and business asset holdover relief, both of which require there to be shares in a trading company or a holding company of a trading group, as defined by section 165A. So trading company means a company carrying on trading activities whose activities do not include to a substantial extent activities other than trading activities. Now HMRC accepts that in this context, substantial means more than 20% based on the following indicators. So turnover, value of trading assets or non-trading assets, expenditure incurred or time spent by employees in the company's history. So we're looking at everything and saying we must make sure that investments don't constitute in the round more than 20% of the business, otherwise we lose our access to CGT reliefs. From an inheritance tax perspective, the potential issue is the loss of business property relief. Now, business property relief is generally available at 100% on shares in unquoted trading companies, but it's denied, where the business consists wholly or mainly of the making or holding of investments. And mainly in this context means more than 50%. So we're looking to ensure that overall, when looking at the factors on the slide here, similar to those factors for CGT, that the business remains predominantly trading, and then you should continue to get your business property relief. Surplus cash within a company may be an accepted asset, the value of which would be denied BPR even if the company was otherwise trading. So you just isolate that value that's attributable to accepted assets and deny BPR on that. Won't run through the definition in the interest of time, but using surplus cash for investment should prevent its value from being accepted. So for inheritance tax, it's really efficient actually to hold modest investments and ensure that surplus cash does not become an accepted asset. But this is actually in conflict with capital gains tax, where retained trading profits will rarely taint the trading status of a company for BADR and or holdover relief. So it's just one of those areas that you need to consider regularly for clients where this might be relevant. And actually the IHT and CGT rules are to some extent in conflict with one another. The next few slides look at situations where perhaps it might be necessary commercially to hold investment assets in a different company within the same group. And here, just to summarize very, very quickly in the interests of time, it would generally be better to hold investment assets within a holding company rather than a trading subsidiary. An investment subsidiary. An investment subsidiary would always be an accepted asset under section 111 of the Inheritance Tax Act, whereas there's an exception from those rules where it's within a holding company, and the holding company is still consists wholly or mainly of being a holding company of a trading group, essentially. If the trading status of the group is in danger such that CGT or IHT reliefs might be denied altogether, then we would often look to split the investments into a separate group, and that can be done with typically non-statutory demerger, either under the section 110 liquidation route or now possibly more likely under the capital reduction route. And that's where I'm going to stop. The next few slides you can take away with you and just shows how we might go through a capital reduction demerger in this situation. But I'm going to skip through, get to the slide that says questions, and then hopefully John, or hopefully I think it's John, hopefully John will be able to read out some of your questions. Thank you.
Thank you, James. A super summary gives me a lot of complex information. So I'm delighted to say that James and MHA have offered to enable people to contact them afterwards, and there'll just be a sort of a slide that pings up in a second. There we are, which just deals with the logistics of that. So whilst that's up, I just want to spin through. We've got lots and lots of questions, lots of really good questions. So I'll try and batch these a little. Some questions come in around accruals and cash basis. Can you make an election each year, or once you made the election, effectively, are you stuck with it?
Hang on, sorry, I'm just trying to stop sharing my screen, John.
Not at all.
Sorry, can you repeat the question? I was
yes, of course. Yeah. So some questions came in around election for accruals or cash basis. Yeah, can you do this year on year, or is it non-reverse?
I believe you can. You can't use that to your advantage to take profits out of account altogether, for example, but you can opt in and opt out, I believe. Yeah. Okay.
Costs such as service charges, electricity and community charge on an empty flat that was not previously let incurred prior to commencement of rental period, can these be offset against rental income?
If it's a flat that's acquired for letting, and you are kind of in the process of trying to let it, incurring costs, those costs would be akin to pre-trading expenditure. So it's one of those situations where you look at the trading rules and apply it to the property investment activity. If that's just one of a number of property investments, so it forms part of the property investment business, albeit it's not let, then actually those costs should be deductible when they are incurred as a cost of the rental business. Of course, this is all said on the basis that the intention for that flat is for it to be let out.
Okay, thank you. A number of questions coming in around, I think, marrying up the legal ownership of property as recorded on the land registry, and whether it can be varied if, for example, it were owned 50-50 and recorded as such, or perhaps owned on 100% by a spouse or partner, civil partner. Could that then be varied in some respects that you've been referring to, or are you nailed into the legal registration, in other words?
Well, firstly, say I'm not a lawyer, so forgive some of the terminology, but the legal ownership is not entirely relevant. It's the beneficial ownership that's relevant, and of course they can be different. So you can have a situation where I, as legal owner of a property, hold that property on trust, let's say for myself and my wife in equal shares. Yet beneficially, that property is owned 50-50, myself and my wife, and we would have to, and the rental income would arise to us jointly, and we would declare it jointly for tax purposes. If, however, I own the property legally, and I declare that I own that property on trust for myself and my wife in the proportions 90% my wife, 10% myself, I could then make an election and fill in Form 17 to have the rental income assessed as to 90% on my wife and 10% on myself. Does that make sense?
Absolutely, James. Thank you very much for that. Transferring existing rental property to a partnership, what are the downsides of this?
One of the, I'm going to say this, one of the benefits of partnerships is that actually it's very, very easy to unravel. So I would say that there isn't much in the way of downside. Clearly, if you're going to the expense and administration of setting up a partnership or an LLP, then the downside would be, well, that you might not get any benefit from it, unless there's a real reason for it. But in terms of tax, the assets can be put onto the partnership without capital gains tax, provided there's no change in underlying, ownership. Assets can be put onto a family partnership without stamp duty land tax under the provisions within Schedule 15 of the Finance Act 2003. So, sorry, that's a bit of a not the clearest of answers, but I don't think there are significant downsides.
No, that's an excellent answer. Thank you. Very one sort of particular one here, but I think it raises a few broader questions. How long would a son have to be in co-occupation with the father of a newly bought residence in joint names from the father's assets for the property to fall out of IHT of the father?
Well, it will never be the case that the property will fall entirely out of account, but in that situation, the father might acquire the property in joint names, thereby there being a potentially exempt transfer of half of the acquisition cost, for example. Okay, so that gift would be a potentially exempt transfer outside of dad's estate after 7 years has passed. So half the property would remain in dad's estate in that example, and half would fall out of account after 7 years. That does rely on son being in residence, that's, don't think that's defined, but he's got to live there essentially. The other point to note is that on a kind of literal reading of the rules, it would be possible to be well, you might think it would be possible to be aggressive. So in other words, have the property owned 1% by dad, 99% by son, and get the majority of the value out of dad's estate if son resides there. HMRC are very clear that they do not like and will not entertain aggressive situations like that. So in the example that within the question, 50-50 ownership would be probably as far as I would go.
So I'd like to now draw the session to an end, to thank MHA and obviously James in particular for delivering really his encyclopedic knowledge, as I call a super expert on this area. There's a lot of complexity, which of course lends itself to a lot of planning opportunities. And I thought some of the things on Alphabet Shares and the family investment company look particularly interesting. So thanks again, James. Look forward to meeting everybody again on our next session. Thank you and goodbye to everybody.